Thanks again for joining me on another video. If you're new here, my name is Mike Weber. I'm a real estate broker here in Los Angeles. Today, I want to cover some additional information that has recently come out about the real estate market. I have some great graphs to share with you guys today. And what we're seeing are some serious cracks in new homes across the nation. In fact, this very well may be the canary in the coal mine, if you will, of what's to come for the housing market in general. But without further ado, let's go ahead and jump in and take a look at some of this new data. And if you're looking to sell a home here in Los Angeles County or North Orange County, reach out to me. Let's make sure that your home is one of the ones that does sell and you get the service you need and deserve. Or if you're thinking about taking advantage of this weakness in the market and buying a place, reach out to me on that as well. My contact information is down below. So getting started, we see here that US new home sales disappoint in June as prices plunge. And as we can see here, following yesterday's disappointing existing home sales print, this morning sees new home sales confirm the disappointment with a mere 0.6 month-over-month rise, well below the 4.3% month-over-month rebound expected after tumbling 11.6% month-over-month the month prior. And what I'm going to show you next is actually pretty remarkable. The new median new home prices plunged in June near 5-year lows, now well below that of existing homes. And you can see here, look at this on the graph. The green represents the new home prices and the red represents existing home prices. And you can see that going back all these years, even as far back as 2000, 25 years ago, pretty much all those years, new home prices were always above the cost of existing homes. And that's for obvious reasons. People generally, if they have the choice, are going to prefer to purchase a brand new home over a home that's, 10, 20, 30, 40, 50, and in some cases 100 years old, depending on where we're talking about. But look what just happened. All of a sudden, we are seeing the biggest divergence in new home prices compared to existing home prices that we've pretty much seen on this entire chart going back 25 years. And I believe this is telling us something very important that we need to pay attention to. See, the thing is, with new home sales, you're dealing with corporations that are intelligent, that understand the market, that are making the best decisions possible to ensure that they protect their shareholders and their stock price. And so they're going to do whatever is necessary within obvious constraints to make sure that they continue to sell homes, properly incentivize home buyers to continue buying homes, etc. And that's exactly what we're seeing. We're seeing them drop prices substantially and increase the incentives that they're offering substantially in order to entice buyers to purchase those homes. Whereas conversely, we've been seeing this extreme stickiness on the existing home seller side, where home sellers refuse to lower prices to where they need to be to actually cause the homes to sell and clear the market. So what is happening is new home prices are leading the way. And if new home prices are falling well below existing home prices, why are people in those markets going to buy any existing homes at all at the higher prices? Well, of course, in most all cases, they're not, which means existing home sales are going to look absolutely horrible until sellers become more realistic and start pricing their homes accordingly. And I have news for you. If new homes are being priced by builders vastly lower than existing homes in the same markets, and on top of that, they're offering huge incentive packages to potential buyers, such as upgrades to the home, paying the buyer's closing costs, and in some cases paying the down payment for the buyer so they can come in with zero out of pocket to buy a brand new home. Existing home sellers are not going to be able to compete with that, and homes are going to stop selling in those markets almost completely. And here it shows how extreme the difference is between the new homes and the existing home median prices. And we could see it's negative 33.5. So that is 33.5 thousand lower. So this means that new homes are being sold for $33,500 less than existing homes. And as we're about to also take a look at, these new homes are in general offering vastly higher incentives than home sellers of existing homes, which is going to further incentivize buyers to buy new homes and stop buying existing homes to the extent that the markets have new homes available for home buyers to buy. And as we can see here, we have a little blurb about Pulte Group. They're a home builder. This week, Atlanta-based Pulte Group relieved investors by posting better than expected earnings despite reporting a slowdown in new home orders. So somehow with the incentive structure, the lower prices, this somehow ended up helping their earnings. But of course, how long can that go on for before those higher incentives and falling prices start to really make a serious dent in the financials of these home builders? Sales incentives have grown to 8.7% of its house's gross sales price, more than double a normal incentive load, executives said on an earnings call. And I have news for you. Builders having to give buyers 8.7% in incentives on the price of the home is definitely not a good sign for the real estate market. And trust me, as a real estate broker and a professional, convincing sellers to give up 8.7% in incentives to incentivize a buyer to buy their home is not going to be an easy task. So in markets like Texas and Florida, Arizona, Nevada, where there's a lot of new home construction, if you are selling an existing home, you have to pay very close attention to what your competition, new home builders, are doing to take away potential buyers from buying your home so they can get them into a brand new home at a much lower cost with a whole bunch of wonderful incentives. And here the CEO says, I long for the days of more normal incentive loads of kind of 3 to 3.5%. And look at this. Thursday's government report showed the supply of new homes for sale in June increased to 511,000, still the highest level since 2007. Now, guys, I don't know about you, but this is not looking good for the new home sales market. We constantly have the media and all kinds of companies involved in the real estate space and all kinds of commentators talking about how undersupplied the US housing market is, but yet look at the chart, look at what the facts are actually telling us. We have been seeing rising supply for new homes going all the way back to 2012 since the great crash of 2008. And despite a small dip here during the pandemic, which obviously builders had to slow things down, things have been back off to the races, and we have a massive supply of new homes that pushes us back all the way to the crisis in 2007, 2008. So what does that mean? That clearly means that new home prices are just too high because not enough people are able to afford them, especially now with interest rates also being much higher than we had for many, many years. And the last chart that I want to show you guys that I think is important to take a look at is this one here. And by the way, I will link these down below if you want to take a look at them. But this chart here shows us two things. It shows us the mortgage interest rates, and then it also shows us the new one-family houses that sold. Now, it's important to understand on this chart, the blue line is interest rates, and it's an inverse chart. So the higher it goes, the lower the interest rates, as you can see here on the y-axis. The higher up it goes, the lower the rates. Now, traditionally, as rates get higher, home sales are naturally going to fall. And that is the trend that we've seen, going back a couple years here on this particular chart that they're showing us. Rates get lower, home sales go up, and vice versa. But look what's happened recently. Here, we've seen long end rates, the 10-year rate or mortgage rates, go slightly down. They've been falling a little bit, over the last couple months or whatever it is. But look at what has happened to home sales. Instead of following and going up along with the lower mortgage rates, they're actually plummeting. And so what that tells us is that the market is not responding to slightly lower rates. Now, is this going to prove to be the canary in the coal mine now that we're seeing rates come down a little bit and new home sales still crash? I don't know, but it's definitely something very different to what we've been experiencing the last couple of years. Now, one more article I want to share with you. US existing home sales dipped back near 15-year low in June as prices hit record high. And what I really want to show you in this article is just the trend of existing home sales. And you can see here, we are down for the last several years, kind of in this range that we can't break out of. And this puts us back to the big crash all the way back to 2008, 2009, 2010, where nobody was buying anything. Prices were crashing substantially, and there was very, very few homes selling. And we've been stuck in that same sort of range for the last couple years. And here they confirm the median sales price increased 2% in June from a year ago to a record high of $435,300. And here's a chart that shows us the same. We can see that amazingly, even with all the other weakness in new housing that we're seeing, the decline in sales, the decline in pending sales that we've talked about on this channel, somehow, miraculously, the homes that are still selling are selling for higher prices across the United States when averaged out or when combined, even though a lot of markets are declining. And the final thing I want to talk about here in this article is mortgage rates. And here it says, economists at Goldman Sachs said in a recent note that 87% of mortgage holders have rates below current rates, and 2/3 have borrowing costs 2 percentage points below current rates, strongly disincentivizing them from moving. And this graph really shows us the whole story. The blue line here represents the effective mortgage rate. So that's kind of the rate, if you were to combine all the mortgages that are outstanding, what is kind of the effective or maybe the average sort of rate that everybody's paying? I don't know exactly how they calculated it in this graph, but that's essentially what it is. And the red line shows us the actual 30-year mortgage rate. Now, going all the way back to 2000, look what we see. We see the red line, the actual 30-year fixed mortgage rate, starting to decline, and along with that, the effective rate, because obviously people are going to continue to refinance as rates fall, and then new mortgages are being made at lower and lower rates, which brings down that effective rate. And even here, when they lowered them after the housing crash, they got low, and then of course people continued to refinance and purchase at lower and lower rates. And then look what happened. We had all this price growth. Everything was extremely competitive because rates were relatively low. And then there was one last hurrah around 2019, 2020, when the central bank lowered rates. That's when rates got below 3%. And then in this window here, that's when everybody and their grandmother, if they could qualify, refinanced their loan or sold their house and bought a new house and locked in those extremely low rates. And look what has happened since then. The actual 30-year fixed mortgage rate has skyrocketed up and is now around 7%. But the effective rate that homeowners who actually have mortgages outstanding are paying is substantially lower at 4.05%. So there's almost a 2.73% delta between these two numbers here. And that is what has been driving the lock-in effect, meaning that a lot of sellers have been hesitant to sell their homes and give up that low rate. And then, of course, buyers also, in many cases, don't want to pay the high rate or can't qualify with the higher rates. And that is what has slowed the housing market down to a crawl. And that is what has caused closed sales to be so low and pending sales to be so low as well. And of course, now it's causing prices to fall, particularly in new homes, and as well in existing home sales in many markets across the country. So do me a favor, let me know in the comments down below what you're seeing in your market. Let me know if I can help you with real estate. I appreciate you guys watching, and I'll see you on the next video. Take care.